People love to say real estate always wins. Others swear the stock market beats everything if you just wait long enough. Everyone's got an opinion, but very few ever run the math. So here's what happens when two people start with the same money. One buys a rental, the other buys the market, and time decides who really wins. Ethan buys a rental property. Liam invests in index funds. They both think they've cracked the code. They start exactly the same. $55,000 in savings, $60,000 salaries, and zero debt. The only difference is what they do with that money. Ethan uses his $55K as a 20% down payment on a $275,000 single-family rental in a decent neighborhood. He takes out a 30-year mortgage at 6.7%. His monthly payment, about $1,420. He finds a tenant paying $1,950 in rent. On paper, that's roughly $530 profit per month, or $6,000 a year before expenses. He's building equity, claiming depreciation on taxes, and watching Zillow for price jumps. Everything looks great, on paper. Liam puts his entire $55K into a low-cost index fund. He sets up an automatic $350 per month contribution and calls it a day. No keys, no tenants, no stress. While Ethan's fixing leaky faucets, Liam's portfolio grows slowly but consistently, up, down, and up again. At first, it's boring, but so is compound interest until it isn't. Ethan collects around $117,000 in rent over 5 years. After paying the bank, property taxes, $3,000 a year, insurance, $1,200 a year, and 2 repairs totaling $6,000, his net cash flow shrinks to about $8,000 total profit for that period. That's roughly $1,600 a year, not the $6,000 he projected. Still, his property appreciates 3 to 4% annually. It's now worth around $320,000, and his mortgage balance has dropped to $240,000. That's about $80,000 in equity built up in 5 years. Not bad. Liam's path looks dull but clean. His portfolio, with consistent contributions and an average 9% annual return, now sits around $95,000. He's contributed $76,000 total, meaning about $19,000 of that is pure market growth. His wealth curve is finally bending upward. Ethan feels in control. Liam feels detached, but math doesn't care who feels better. At this point, Ethan manages every call himself. A burst pipe on New Year's Eve cost $2,100. The water heater failed 6 months later. Each problem seems small until you realize there's always another one. He's earning a return, but working for it. A part-time job he didn't know he signed up for. Liam, he forgets his brokerage password and resets it once a year. That's the extent of his management. After 20 years, Ethan's property has appreciated steadily to $520,000 to $550,000. His remaining loan balance is about $80,000, giving him $440,000 to $470,000 in equity. Over 20 years, he's collected roughly $420,000 total rent and likely spent $100,000 to $120,000 on taxes, insurance, maintenance, and repairs. If you add up the net rent profit, around $50,000 to $70,000, plus his full property equity, Ethan ends up around $500,000 in total wealth from that investment. Not bad, but it came with loan risk, time demands, and constant involvement. Liam, meanwhile, has been hands-off the entire time. His indexing habit, $350 per month with 9% average returns, now totals around $480,000 to $520,000. He invested $139,000 total, meaning about $370,000 of that came purely from market growth. They end up in almost the same place, wealth-wise, one by working for it, one by waiting for it. For Ethan, leverage amplified returns. He controlled a $275,000 asset with only $55,000 down. If the market had jumped 5% a year, he'd have crushed Liam's results. But leverage cuts both ways. A bad tenant, big repair, or local downturn could have wiped out years of profit. Liam's biggest enemy was volatility. He watched his portfolio drop 30% in one market crash, then soar again with patience. The difference is emotional. Ethan's stress came from broken pipes, Liam's from red numbers on a screen. Real estate gives control and cash flow potential. Stocks give freedom and liquidity. Both can make you rich, but one demands time, the other demands patience. If Liam had increased his deposits from $350 to $500 per month, his 20-year portfolio jumps near $650,000. Just an extra $150 a month changes the game. That's the multiplier power of compounding. For Ethan to match that, he'd need to buy another property, meaning another loan, another tenant, and double the stress. Still, real estate wins hands down when done professionally. Investors who buy in strong rent-to-price markets, where monthly rent equals 1% of property value, and manage systematically, can absolutely outperform stocks. Conversely, stock investors who panic sell during crashes or chase hype underperform dramatically. Each asset rewards discipline and punishes emotion. Ethan and Liam didn't choose wrong, they chose incomplete. Real estate builds equity you can touch. Stocks build wealth you can withdraw. The smartest move isn't about picking sides, it's about balancing both. Over 20 years, they both grew their net worth by $500,000, but their lives looked nothing alike. One fixed toilets, one slept through crashes. The truth nobody likes to mention: the best investment isn't the one with the highest return. It's the one you can stick with long enough for compounding to work. So next time someone says real estate always wins or the market never fails, just ask, did you count everything? Because whether it's time, risk, repairs, or stress, the numbers you forget to count can change everything. This is Net Plus, where money stops being a mystery and becomes a language you finally understand. Hit subscribe for more deep dive lessons that actually stick.